Moving gold is actually very easy because you could move it to the UK, or you could move it to France, or you could move it to Switzerland, and there's no duty and there's no tax involved. You couldn't move bars, but you could move gold coins that were in circulation.
Bob Moriarty, a seasoned financial commentator and resource sector expert, offers a wealth of experience and insight. His sharp market acumen and deep mining industry understanding have earned him attention and respect, making him a notable figure in the financial realm. In this video, Moriarty shares insights regarding the varying regulations on buying and selling precious metals like gold, silver in different countries. In France, there is a 7% tax on the sale of certain historical coins, including Russian rubles, German marks, French francs, and British sovereigns. This tax was introduced in 2014, and it has been criticized by some collectors and investors who argue that it makes it more difficult to sell historical coins in France. The capital gains tax on physical gold and silver is equal to an investor's marginal tax rate, up to a maximum of 28%, meaning those in higher tax brackets still only have to pay 28% on long-term gains from physical precious metals sales. Bob emphasizes mining's essential wealth generation, with costs like labor and fuel decreasing relative to valuable extracted commodities like gold and silver. The results of our research on the direction of financial contagion between the banking and mining sectors provided arguments that, in 2008 to 2019, the negative impulses came mainly from banks. In 6 countries, Australia, Canada, India, Russia, the UK, and the USA, in certain time windows, the mining sector was identified as a potential source of contagion. We will now bring you clips of Bob Moriarty from his recent interview with Liberty and Finance. Before we proceed further in this video, please make sure to subscribe our channel and click the bell icon to stay updated.
For people in the UK, and this is for anybody, I mean, you go to the UK, you can buy British sovereigns with no VAT, no tax, and you could sell them if you're a UK citizen with no tax. Now, in France, you can buy coins like the Russian ruble, like the German mark, like the French franc, like the British sovereign, coins that were legitimate coins in circulation. You could buy them with no tax, no premium. However, in France, you have to pay a 7% tax when you sell it. So the answer is basically every country is different, but some things are relatively similar across the board. Buying and selling silver is a bit of a problem outside the United States and Canada. You're going to pay a premium and you're going to pay tax on it in most places. Same thing with platinum and palladium. So it's going to vary from country to country. The gold eagle never was a circulating coin. So you would pay VAT or duty on it in the UK and France because it would be treated as something other than a circulating coin. But the answer in general is it varies from country to country. Some things are very easy. Buying sovereigns, buying French francs, buying D-marks, gold rubles. Those tend to be very easy. And I have a friend that just went to Russia and buying gold and silver at spot. You just walk into a bank there. I think it would be a stretch to call them banks because banks take in money and loan money, and mining companies don't do that. However, the real key is they're producing real wealth, and the cost of their inputs, the cost of diesel, the cost of labor will have gone down in relative terms to the value of gold or silver or any other commodity that they're making. Mining companies were a big part of the economy back during the Depression, to the tune of 9 or 10% of the economy. And they were 3% of the economy as late as 1980, and they are half of 1% of the economy now. So if the question is, will mining stocks reflect real value? I think the answer is absolutely yes.
During the interview, Moriarty concerned that around half of U.S. banks are possibly on the brink of bankruptcy, which might trigger a domino effect impacting other banks. First Republic Bank, FRC, Silicon Valley Bank and Signature Bank are the second, third, and fourth largest bank failures in U.S. history. This year's collapses are even bigger than those during the 2008 financial crisis. Moriarty highlights two key developments: the IMF permitting the Chinese yuan for settlements, and a notable credit rating downgrade for the U.S. government. The Argentine government has reached an agreement with the People's Bank of China to secure U.S. $1.7 billion in yuan through currency swaps to meet its U.S. $2.7 billion payment obligations to the International Monetary Fund, its economy minister said on Monday. Moriarty points out a worrying trend that around half of U.S. banks have a value up to 20% lower than their market cap. Following bank collapses, central bank actions may also have an impact on the price of gold and silver. Central banks may act to maintain the financial system's stability once a bank fails. Let's get back to interview.
We had more banks collapse in March than collapsed in 2008. They've been holding back the dam, but it appears the dam is bursting now. And there was a piece I posted 2 days ago. Half of U.S. banks with $11 trillion in assets have lower asset value compared to debt liabilities. Their asset value is $2.2 trillion lower than their book value. So literally, I mean, what they're saying is half the banks in the United States are bankrupt right now. And when they go, they'll take the rest of the banks. Now, there's several things that are very important to notice here. The IMF just allowed the Chinese yuan to be used as a currency to settle accounts. That's a really big deal. It's something that would be invisible to most people. That's a big deal. And second of all, the credit rating of the U.S. government has just been lowered. We have had record highs in the Dow and the S&P and the NASDAQ literally up until a few days ago. And I think lowering the credit rating is pulling the plug on the financial system. We'll see very soon. I'm not sure anybody can predict that. Certainly the powers that be are trying to cover it up. It's like a cat in a litter box, okay? Once they crack, they do their very best to cover it up and pretend it doesn't exist. They've done an excellent job, and I thought back in March it would be cascading immediately, and it obviously hasn't been. But the piece I just sent you from 2 days ago, half of the banks in the U.S. are worth 20% less, or have a negative 20% value. If they got $100 billion in market cap, they've only got $80 billion in assets. So the banking system is extremely fragile, and that's true throughout the world. We have discussed the quandary the Fed is in. If they keep raising interest rates, they blow the system up. If they lower interest rates, we get hyperinflation, and they chose to blow the system up. And that's what the credit agencies just said.
The analysis sheds light on the fragilities within the gold and silver markets. With potential bankruptcies looming and a domino effect in play, it's crucial to grasp the intricacies of these precious metal sectors. As we navigate these complex dynamics, how do you envision safeguarding investments in gold and silver? Share your thoughts in comments section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more interesting topics. Thank you for watching.